The money you earned last year is worth less today, not because of what you did, but because of what happened on January 30th, 2026. Between Thursday morning and Friday afternoon, silver lost 31% of its value, the largest single-day collapse since March 1980. Gold fell 11% in the same window. These are not corrections. These are ruptures. And they occurred while most people were checking their phones, unaware that the mechanism designed to preserve their purchasing power had just fractured in real time. Here is the data point that matters. The gold-to-silver ratio compressed 45 points in under 9 months, from 100 to 1 in April 2025 to 57 to 1 by January 2026. That rate of compression has appeared exactly 3 times in modern history. Each time, it preceded a violent unwinding. This is not speculation. This is pattern recognition. The question is not whether the system will correct. The system already corrected. The question is what breaks next when the mechanism that was supposed to protect you becomes the source of instability. I'm John A.G., and this is the Collapse Files. On January 30th, 2026, President Donald Trump nominated Kevin Warsh to succeed Jerome Powell as chair of the Federal Reserve. The announcement was made at 10:47 a.m. Eastern Time. Within 6 hours, spot silver had fallen 28% to $83.45 per ounce. Gold dropped 9% to $4,195. Silver futures plummeted 31.4% to settle at $78.53. It was silver's worst day since March 1980, when the Hunt brothers' attempt to corner the market collapsed. Gold fell 11.4% in futures trading to close at $4,745. The magnitude was staggering. Gold had touched an all-time high of $5,594.82 just 24 hours earlier on January 29th. Silver had reached $121.64 per ounce on the same day. The combined destruction in value exceeded $800 billion across physical holdings, futures contracts, and exchange-traded funds. The ProShares Ultra Silver Fund lost 62% in a single session. The iShares Silver Trust fell 31%, marking its worst day on record. This was not gradual. This was instantaneous. The move began with Warsh's nomination and accelerated through the afternoon session as leveraged positions were liquidated. By market close, gold had given back $830 from its peak. Silver had surrendered nearly $40 per ounce. Both metals had been in parabolic rallies for months. Gold was up 65% year over year. Silver had gained 145%. The violence of the reversal reflected the extent of the preceding surge. But the collapse did not end on Friday. On Monday, February 2nd, the CME Group implemented margin requirement increases. Gold margins rose from 6% to 8% for standard risk profiles. For heightened risk profiles, margins increased to 8.8% from 6.6%. Silver margins jumped from 11% to 15% on the 5,000-ounce COMEX contract. The stated reason was market volatility. The actual effect was forced liquidation. The timing of the margin increase matters. The CME announced the changes on Friday, January 30th, but implemented them after market close on Monday, February 2. This gave traders the weekend to assess their exposure. Many realized they could not meet the new requirements. The result was preemptive selling when Asian markets opened Sunday evening. Gold fell to $4,123 in early Monday trading before recovering. Silver tested $78. These were not orderly markets. These were fire sales. When margin requirements rise, traders must deposit additional capital or close positions. Many chose to close. By Monday afternoon, spot gold had fallen an additional 10% intraday before recovering to $4,680. Silver dropped 15% before stabilizing around $81. The combination of price collapse and margin increases created a cascading effect. Positions that were profitable on Thursday were underwater by Monday. Traders who had held through Friday's decline were forced out by the margin calls. The margin system operates on a simple principle. Exchanges require traders to post collateral equal to a percentage of contract value. If prices move against the position, the trader must deposit additional funds to maintain the margin. If they cannot, the exchange liquidates the position. The January 30th collapse triggered margin calls across thousands of accounts. The subsequent margin increase on February 2nd triggered a second wave. Traders faced compounding losses without the capital to cover them. The scale of this move cannot be overstated. In 48 hours, silver lost 1/3 of its value. Gold shed nearly 20% from peak to trough. These are assets that had been marketed as stores of value, hedges against currency debasement, and safe havens in times of geopolitical uncertainty. And they collapsed faster than most equity indices during comparable periods of stress. The speed and severity of the decline revealed something structural about how these markets function under pressure. Consider the trajectory. Gold began 2026 at approximately $4,100 per ounce. By January 29th, it had reached $5,594. a gain of $1,394 in 29 days, an average of $48 per day. That rate of ascent was unsustainable, but markets do not recognize unsustainability until it ends. The final push from 5,000 to 5,594 occurred in 5 trading sessions. The blow-off top. When the reversal came, it erased 4 weeks of gains in 48 hours. Silver followed an even more extreme path. The metal began the year around $75 per ounce. It peaked at $121.64 on January 29th, a gain of $46.64 in 29 days. But the final surge from $100 to $121 occurred in just 3 days. The parabolic move. When it reversed, silver fell from 121 to 78 in 2 sessions. The entire January gain was erased. Traders who had bought at any point in January were now holding losses. The precious metals market operates on a pyramid of physical metal, futures contracts, and financial instruments. At the base is physical gold and silver. Above that sits the futures market, where contracts represent claims on future delivery. At the top are leveraged instruments, exchange-traded funds, and derivative products. The system functions when all 3 layers remain in equilibrium. It fails when one layer dominates price discovery. For the past 24 months, the futures market had been the primary driver of price. Open interest in silver futures had reached historic levels by January 2026. The number of outstanding contracts exceeded available physical inventory by a factor of 300 to 1 in some delivery months. This is not unusual. Futures markets routinely operate with paper claims vastly exceeding physical supply. The assumption is that most contracts will be closed before delivery. The problem arises when that assumption breaks. Central banks had purchased 863 tons of gold in 2025, according to the World Gold Council. That figure was below the 1,000-ton threshold reached in each of the previous 3 years, but it remained historically elevated. The National Bank of Poland added 102 tons. Turkey bought 27 tons. China reported 27 tons, though actual purchases were likely higher given the pattern of unreported accumulation. These purchases occurred at prices between $3,000 and $5,500 per ounce. At the same time, retail investors piled into gold and silver through exchange-traded funds. Physically backed gold ETFs recorded their largest monthly inflow in September 2025. The strongest quarter on record totaled $26 billion in new capital. Silver followed a similar pattern. Investor demand reached levels not seen since the 2011 peak. The difference was that 2011 prices collapsed from $50 for silver and $1,900 for gold. In 2026, prices were starting from $120 and $5,600 respectively. The futures market amplified these moves. Traders used leverage to multiply exposure. A 10% margin requirement meant that $10,000 could control $100,000 worth of metal. When prices rose, profits were magnified. When prices fell, losses were catastrophic. The January 30th collapse triggered margin calls across the entire curve. Traders who had been long at $5,100 for gold faced losses exceeding 15% within hours. Those holding silver at $120 saw 30% evaporate. The CME's decision to raise margins was procedural. Exchange rules require margin adjustments when volatility exceeds historical norms. But the timing compounded the liquidation. Traders receiving margin calls on Monday had already absorbed Friday's losses. Many had exhausted capital reserves. The choice was binary: deposit more money or close the position. Most closed. The selling pressure drove prices lower, which triggered additional margin calls, which forced more selling. This is the mechanical reality of leverage markets. Leverage works in both directions. On the way up, it creates the appearance of unstoppable momentum. On the way down, it accelerates the collapse. The people trapped in this system are not speculators in the traditional sense. They are pension funds, commodity trading advisors, and retail investors who believe the narrative that gold and silver were safe. They were not positioned for a 30% decline in 48 hours. No risk model anticipated that scenario. The gold to silver ratio tells the structural story. In April 2025, the ratio stood at 100 to 1. 1 ounce of gold could purchase 100 ounces of silver. By January 2026, that ratio had compressed to 57 to 1, a 43-point compression in 9 months. The historical average since 1970 is approximately 54 to 1. The ratio typically ranges between 50 to 1 and 80 to 1 during stable periods. Readings above 90 to 1 signal that silver is undervalued relative to gold. Readings below 50 to 1 suggest silver has outperformed. The compression from 100 to 57 was driven by silver's explosive outperformance. Gold gained 67% in 2025. Silver surged 145%. That rate of divergence is unsustainable. When silver moves twice as fast as gold on the upside, it tends to fall twice as hard on the downside. The January 30th collapse confirmed this pattern. Silver fell 31%, while gold declined 11%. The ratio widened from 57 back towards 60 within a single session. Volume data reveals the depth of the liquidation. On January 30th, futures volume for silver exceeded 500,000 contracts. Each contract represents 5,000 ounces. Total volume represented 2.5 billion ounces of silver changing hands. Global annual silver production is approximately 1 billion ounces. A single day's futures volume equaled 2.5 years of global mine output. This is not normal market activity. This is forced liquidation at scale. Central bank buying provided the foundation for the rally. Between 2022 and 2024, central banks purchased 3,220 tons of gold. That compares to 1,275 tons between 2014 and 2016, a 104% increase. The National Bank of Poland increased its gold reserves from 229 tons in 2018 to 550 tons by the end of 2025. The Reserve Bank of India, People's Bank of China, and Central Bank of Turkey followed similar patterns. These institutions were not trading, they were accumulating. But central bank buying slowed in 2025. The 863 tons purchased represented a 14% decline from the 1,000-ton pace of the previous 3 years. The slowdown corresponded with the price surge. At $5,500 per ounce, central banks did not need to buy as many tons to achieve their reserve allocation targets. A central bank aiming for 10% gold reserves could reach that target with fewer tons at higher prices. The marginal buyer disappeared precisely when the market needed new demand. Exchange-traded fund flows also reversed. After record inflows in the third quarter of 2025, ETF demand moderated in the fourth quarter. By January 2026, outflows had begun. When gold fell from $5,600 to $4,700, ETF holders faced a decision. Hold through the volatility or lock in profits. Many chose to sell. ETF liquidations added to the selling pressure in the futures market. The feedback loop between futures, ETFs, and physical demand broke down. The dollar index provides context. On January 30th, the dollar strengthened to 0.74%, its best single-day performance since June. By February 2, the dollar had gained another 0.63%. A stronger dollar makes gold and silver less attractive to foreign buyers. It also reduces the debasement narrative that had driven much of the precious metals rally. If the dollar stabilizes, the case for gold as a currency alternative weakens. The Warsh nomination signaled potential dollar stability through more predictable Fed policy. Platinum and palladium followed similar patterns. Platinum fell 4.3% on February 2nd after reaching a record $2,118.88 on January 26th. Palladium dropped 2.1% to $1,662.68. These metals had also surged in 2025. Platinum gained 150%. Palladium rose 95%. The entire precious metals complex had become overextended. The Warsh announcement provided the catalyst for a broad-based correction. Mining stocks amplified the decline. Kerr mining lost 17%. Other silver producers fell by comparable amounts. When metal prices collapsed, mining equities suffered disproportionate losses. The market prices and reduced future cash flows, higher production costs relative to revenue, and the risk of project delays or cancellations. The mining sector provides a leveraged bet on metal prices. In January 2026, that leverage worked against investors. The technical indicators told the story in advance. The relative strength index for both gold and silver had reached overbought territory above 70 by mid-January. The 14-day RSI for silver exceeded 80 on January 28th, the day before the peak. Readings above 80 signal extreme conditions that typically precede corrections. The market ignored these signals during the final surge. Moving averages provided another warning. Gold's 50-day moving average had diverged significantly from its 200-day moving average by late January. The spread between the two exceeded $1,000. When the 50-day crosses below the 200-day, it generates a death cross signal. That signal triggered on February 3rd, confirming the breakdown in bullish momentum. Volume patterns also shifted. During the rally, volume increased on up days and decreased on down days. After January 29th, the pattern reversed. Volume spiked on down days and contracted on up days. The volume on January 30th exceeded the 50-day average by a factor of 7 for silver and 4 for gold. Panic selling creates volume spikes. Open interest data reveals positioning. Open interest in COMEX gold futures stood at 558,000 contracts on January 29th, representing 55.8 million ounces, or approximately 1,735 tons. Global central bank purchases in all of 2025 totaled 863 tons. The futures market held twice the size of annual central bank accumulation. That concentration created fragility. For silver, open interest reached 234,000 contracts on the 5,000-ounce contract, representing 1.17 billion ounces. Annual global mine production is approximately 1 billion ounces. When those contracts liquidated, there was insufficient physical silver to absorb the selling. Prices gapped lower as buyers disappeared. The Hunt brothers' silver manipulation of 1979-1980 provides the closest historical parallel. Nelson Bunker Hunt and William Herbert Hunt attempted to corner the silver market through futures contracts and physical accumulation. By January 1980, they controlled approximately 100 million ounces of silver. Prices reached $50 per ounce on January 21, 1980. Within 2 months, silver had collapsed to $11. The decline was triggered by margin requirement increases and regulatory intervention. The COMEX raised margin requirements on silver contracts multiple times between December 1979 and March 1980. Each increase forced leveraged speculators to liquidate positions. The Hunt brothers faced margin calls exceeding $100 million. They were unable to meet the calls and defaulted on their contracts. The default accelerated the collapse. On March 27, 1980, known as Silver Thursday, the price fell 31% in a single session. Banks with exposure to the Hunt brothers faced potential insolvency. The Federal Reserve intervened to prevent systemic contagion. The 2011 silver peak offers another precedent. Silver reached $49.82 on April 28, 2011. The rally was driven by fear of currency debasement following the 2008 financial crisis and subsequent quantitative easing. ETF inflows reached record levels. Retail investors purchased physical coins and bars at premiums exceeding 20% above spot prices. The CME raised margin requirements 5 times in 8 days between April 26 and May 5, 2011. The margin increases from 11% to 18% forced liquidation. Silver fell to $33 by May 12th, a 34% decline in 2 weeks. By late 2011, silver had fallen below $30. It would not revisit the $49 level for another 15 years. The 2011 collapse demonstrated that precious metals are not immune to speculative excess. When margin requirements rise, leveraged positions unwind regardless of the underlying narrative. The gold crash of April 2013 provides a third comparison. Gold fell 13% over 2 trading sessions on April 12, 15, 2013. The decline was the largest 2-day drop since 1983. Prices fell from $1,560 to $1,321 in 48 hours. The trigger was Cyprus's announcement that it would sell 400 million euros worth of gold reserves to fund its bailout. The announcement created fear that other European nations would follow. ETF outflows accelerated the decline. What these precedents share is a common structure. Prices rise on a compelling narrative. Leverage amplifies the gains, margin requirements increase in response to volatility. Forced liquidation overwhelms the bid, prices collapse faster than they rose. The January 2026 event fits this pattern precisely. The narrative was currency debasement and geopolitical instability. The leverage came through futures and ETFs. The margin increases triggered liquidation. The result was a 30% collapse in silver within 48 hours. The mainstream narrative frames the January 30th collapse as a reaction to Kevin Warsh's nomination. Markets interpreted Warsh as hawkish on monetary policy, favorable to dollar strength, and committed to Fed independence. This interpretation triggered dollar strength and precious metals weakness. The narrative is correct, but incomplete. What it misses is the positioning that preceded the announcement. By late January 2026, precious metals had become the most crowded trade in global markets. Open interest in silver futures exceeded historical norms by a factor of 4. ETF holdings reached record levels. Central banks had accumulated for 3 consecutive years. Retail investors were buying physical metal at premiums of 15 to 25% above spot prices. The entire investment community was positioned on the same side of the trade. Crowded trades do not end gradually, they end violently. The Warsh announcement provided the catalyst, but the underlying fragility was structural. When everyone is long, there is no one left to buy. Any negative catalyst forces simultaneous selling. The lack of liquidity on the bid side magnifies the move. What should have been a 5% correction became a 30% collapse because there were no natural buyers at any price level between $120 and $80 for silver. The second order effect involves the narrative itself. For 2 years, the case for gold and silver rested on currency debasement, Fed policy uncertainty, and geopolitical instability. The Warsh nomination addressed all 3. A hawkish, credible Fed chair reduces debasement risk. A market-tested former governor provides policy predictability. The nomination of a known quantity reduces institutional uncertainty. The narrative that supported the rally was directly challenged by a single personnel decision. This reveals a deeper truth about gold and silver. These assets are not stores of value in the absolute sense. They are stores of value relative to the credibility of fiat currency and central bank policy. When that credibility improves, the relative case for precious metals weakens. The January 30th move was not irrational. It was a repricing based on new information about future Fed policy and dollar stability. Mainstream analysis also ignores the role of derivatives. The futures market does not just reflect price, it creates price. When futures volume exceeds physical volume by factors of hundreds to one, the tail wags the dog. Price discovery occurs in the paper market, not the physical market. This inverts the traditional relationship. Physical holders become price takers. Futures traders become price makers. When futures traders liquidate en masse, physical holders suffer losses despite having no leverage. The incentive structure also matters. Central banks accumulate gold for strategic reasons unrelated to short-term price. They hold for decades. They do not sell during corrections. But retail investors and fund managers operate on different time horizons. A 20% drawdown triggers risk management protocols. Stops are hit. Positions are closed. The institutional mandate to preserve capital conflicts with the long-term hold thesis. This creates a bifurcated market where strategic buyers accumulate and tactical buyers provide liquidity. Finally, the media narrative around safe havens obscures reality. Gold and silver are marketed as safe, but safe is a relative term. Compared to equities during a crash, gold may preserve capital. Compared to cash during a 30% decline in 48 hours, gold destroys capital. The framing determines the perception. In January 2026, the framing shifted. Gold and silver were no longer seen as safe havens. They were seen as speculative assets, subject to violent deleveraging. The behavioral psychology also matters. Humans anchor to recent prices. When gold traded at $500-600, that became the reference point. A decline to $5,000 felt like a loss, even though it represented substantial gain from 2 years prior. Loss aversion drives selling. Investors lock in small losses rather than risk larger ones. This creates cascading selling as each price level breaks. The wealth effect compounds the bias. Investors who saw portfolios double in 2025 felt wealthy. When values collapsed, plans became unaffordable. The psychological pain of watching gains evaporate exceeds the pleasure of accumulation. This asymmetry drives panic selling during corrections. The institutional mandate structure creates additional fragility. Pension funds operate under fiduciary duty with maximum drawdown limits of 10 to 20%. When those limits were breached, risk protocols required position reduction regardless of long-term thesis. Institutional selling reinforced retail panic. Algorithmic trading adds another dimension. Models trading on momentum and volatility issued sell signals simultaneously. When prices broke key levels, algorithms triggered. The selling was automatic and massive in scale. Human discretion might have differentiated between technical breakdown and fundamental deterioration. Algorithms do not differentiate. Market structure matters in ways most never consider. When the collapse began during New York hours on January 30th, Asian physical buyers were not active. The natural bid from China, India, and Southeast Asia was absent. The one-sided market magnified the decline. Time zone arbitrage creates discontinuities that allow prices to gap overnight as different markets react sequentially. The January 30th collapse in precious metals is a liquidity event. Liquidity events occur when markets that are presumed liquid freeze during stress. The bid disappears. Sellers cannot find buyers at any reasonable price. Forced liquidation drives prices well below fundamental value. The gold and silver markets demonstrated illiquidity at scale. This matters because liquidity is the foundation of every financial system. When liquidity fails in one market, it raises questions about other markets. If gold, the oldest store of value in human history, can fall 20% in 2 days, what else can fall? If silver, with thousands of years of monetary history, can collapse 30% in 48 hours, where is safety? The answer is that safety is conditional. It depends on leverage, positioning, and the presence of buyers when sellers need to exit. The broader implication involves trust. Markets function on trust that assets can be sold at fair prices within reasonable timeframes. The January 30th event violated that trust for precious metals. Investors who believed they could exit positions without catastrophic losses were proven wrong. The psychological impact extends beyond metals. If the safe haven is not safe, investors must reevaluate all assumptions about portfolio construction and risk management. What breaks first historically is confidence. Confidence in price stability, confidence in market function, confidence in the narrative. The precious metals market had been built on the narrative of inevitable dollar debasement and Fed policy failure. The Warsh nomination challenged that narrative. When the narrative breaks, prices adjust to reflect new reality. The speed of adjustment depends on how far prices had diverged from fundamental value. The gold to silver ratio compression from 100 to 57 suggests that silver had moved well beyond fundamental value. Industrial demand for silver in solar panels and electronics provides a floor, but that floor is not at $120 per ounce. The marginal buyer at $120 was speculating on further price increases, not hedging industrial use. When speculation dominates price discovery, corrections are severe. The signal also warns about the Federal Reserve's credibility problem. The market had priced in Fed policy failure. The surge in gold and silver reflected expectations that inflation would remain elevated, interest rates would be cut prematurely, and the dollar would weaken structurally. The Warsh nomination forced a reassessment. If the Fed maintains independence and pursues disciplined monetary policy, the debasement trade fails. The market's reaction indicates that it now assigns higher probability to Fed credibility under Warsh. But this creates a different risk. If markets have overcorrected to price in Fed success, and that success does not materialize, the reversal will be equally violent. The pendulum swings both ways. A hawkish Fed that over-tightens could trigger recession. A recession would reignite safe haven demand for gold and silver. The current correction could be the midpoint between two extremes rather than the end of the cycle. The lesson from history is that extreme moves in both directions tend to overshoot. Gold's rise from $2,000 to $5,600 overshot fundamental value. The collapse from $5,620 to $4,400 may have overshot in the opposite direction. The equilibrium price lies somewhere between. Finding that equilibrium requires time, volatility, and the washing out of speculative excess. We are still in the washing out phase. The carry trade implications deserve attention. When gold and silver rallied, investors borrowed in low-yielding currencies to purchase precious metals. This carry trade assumed that metal appreciation would exceed borrowing costs. When metals collapsed, the carry unwind added to selling pressure. Investors had to repay loans in appreciated currencies while holding depreciated assets. The negative carry forced liquidation. This dynamic links precious metals volatility to currency markets and global capital flows. Systemic risk also emerges from derivative exposure. Major financial institutions provide over-the-counter derivatives linked to precious metals prices. When prices move violently, these derivatives generate mark-to-market losses. If counterparties cannot meet margin calls, the institutions face credit risk. During the 2008 financial crisis, similar dynamics in mortgage derivatives triggered systemic failure. The precious metals derivative market is smaller, but concentration among a few institutions creates fragility. The regulatory response will determine the next phase. If regulators conclude that excessive speculation destabilized the market, they may impose position limits or higher margin requirements permanently. Tighter regulation would reduce leverage and volatility, but also reduce liquidity. Less liquidity means wider bid-ask spreads and greater price impact from smaller order flows. The cure for excessive volatility could be chronic illiquidity. There's also the problem of contagion. When one asset class experiences violent deleveraging, investors reassess risk across all holdings. If precious metals can fall 30% in 2 days, what about cryptocurrencies, which are even more volatile? What about high-yield bonds, which depend on cheap credit? What about private equity, which operates with significant leverage? The answer is that all risk assets become suspect during deleveraging events. The flight to quality benefits, cash, and short-term government debt. The geopolitical dimension cannot be ignored. Central banks outside the United States accumulated gold as a hedge against dollar dominance and sanctions risk. When gold fell 20%, the value of those reserves declined proportionally. For countries with high gold allocations, this represents a material loss in purchasing power. The National Bank of Poland holds 550 tons valued at approximately $30 billion at 5,500 per ounce. At 4,400 per ounce, that same holding is worth $24 billion, a $6 billion loss in reserves. These valuation losses may alter central bank behavior. If prices remain depressed, some banks may slow purchases or even sell to rebalance portfolios. This would remove a key source of structural demand that supported the multi-year rally. Conversely, if central banks view lower prices as buying opportunities and accelerate purchases, it could establish a floor. The divergence in central bank responses will determine whether we have entered a new phase or merely a correction within the bull market. The monetary policy linkage runs both ways. Gold serves as a barometer of Fed credibility. When gold rallies, it signals doubt about the Fed's commitment to price stability. When gold falls, it signals renewed confidence. The Warsh nomination restored some credibility, but credibility must be earned through policy execution. If Warsh pursues accommodative policy despite inflation above target, credibility will be lost again. If he maintains discipline and inflation moderates, credibility strengthens further. The interest rate path matters more than the level. Markets can price in a 3% federal funds rate if they believe that rate will remain stable. Markets cannot price in uncertainty about whether rates will be 2% or 4% next year. Uncertainty creates volatility. Volatility destroys leveraged positions. The collapse in precious metals reflects recalibration of expectations about policy certainty. If that certainty proves illusory, volatility will return. On January 30th, 2026, the global precious metals market experienced a liquidity event. Silver fell 31% in a single session. Gold declined 11%. The CME raised margin requirements, forcing further liquidation. Within 72 hours, the entire structure of the precious metals rally had collapsed. The magnitude and speed of the decline exceeded all modern precedents except the Hunt brothers manipulation and the 2011 peak. The trigger was Kevin Warsh's nomination to lead the Federal Reserve. The underlying cause was extreme positioning, excessive leverage, and a narrative that could not withstand challenge. When all participants are positioned on the same side of a trade, any negative catalyst creates forced selling. The lack of natural buyers amplified the decline. What should have been a correction became a collapse. The implications extend beyond metals. This was a test of market structure under stress. The markets failed the test. Liquidity vanished. Price discovery broke down. Investors who believed they held safe assets discovered they held speculative instruments subject to violent deleveraging. The lesson is clear. Safety is not an inherent property of an asset. It is a function of leverage, positioning, and liquidity. The path forward remains uncertain. Gold and silver may stabilize at current levels. They may fall further if leveraged positions continue to unwind. They may rally if geopolitical events or Fed policy errors reignite safe haven demand. What cannot happen is a return to the parabolic trajectory of 2025. That trajectory required constant new buying. The marginal buyer has been eliminated by losses exceeding 30%. April 2026 marks the confirmation hearing for Kevin Warsh. The Senate Banking Committee will question his views on monetary policy, Fed independence, and dollar stability. His answers will determine whether the market's reassessment of Fed credibility was justified. If Warsh confirms hawkish discipline, the dollar strengthens and precious metals remain under pressure. If he signals accommodation to political pressure, the debasement trade resurfaces and metals rally. The market will not wait for the actual policy. It will price in expectations during the hearing. This is not financial advice. This is pattern recognition. The pattern suggests we are in the middle of a repricing, not the end. Repricing events take time to resolve. They require the complete unwinding of speculative excess and the establishment of new equilibrium prices. The January 30th event cleared some excess. It did not clear all excess. More volatility is inevitable. The only certainty is that the assumptions that drove prices from $2,000 to $1,600 no longer hold. What replaces those assumptions will determine where we go from here. The mechanism designed to preserve purchasing power became the source of catastrophic loss. That is what happened. What happens next depends on whether the lessons are learned or repeated.